Hi, good morning, everyone. Thank you very much for joining, and welcome to our panel guests today. We're talking about finding liquidity in cryptocurrency markets. This obviously has been one of the perennial questions in crypto markets over the last 11 years since the birth of Bitcoin, and it's a real issue for the development of these markets and the fundamental question of whether cryptocurrency markets can at any point start to mirror markets for traditional assets. So we have a very strong panel today, and I'd like to just jump straight in. Maybe before everyone answers the question, they can give a very brief introduction. Just to start by asking Kevin Beardsley from B2C2, Kraken Futures, my bad. Exactly how we should go about thinking about liquidity in cryptocurrency markets. These markets tend to be very opaque, and there are questions about transparency. What are some of the best ways to actually work out where liquidity lies in crypto markets these days?
Yeah, so by the way, I'm from Kraken Futures. So the numbers that you see on like CoinMarketCap are probably optimistic for a lot of the exchanges that are at the top, if not outright fraudulent. So a couple of actual statistics. So from skew.com this morning, which is probably the best resource for derivatives in information in crypto, the bid-ask spread on $10 million at BitMEX was about 12 basis points. If you talk to market makers that do electronic OTC, they estimate, generally speaking, that you can put about $20 million into the market in a day without moving the price in a meaningful way, and that's spread across a great many exchanges. So then, those are sort of like actual facts. And then if you talk to the market makers out there, and especially the ones we work with, they'll tell you that if you look at the big exchanges, so BitMEX, OKX, Huobi, Coinbase, Kraken, the volumes, especially on potentially the OKX and Huobi, might be a bit optimistic. But generally speaking, you can trade there at scale. So whether the actual number they put on CoinMarketCap is precisely accurate is less of a question than can you trade on these venues at scale, and does it work properly? And I think for the larger ones, it probably does. Now, differentiating between OKX and BitMEX can be difficult for people that come to the space these days, and that's perhaps a different question.
Sure. Tim McCourt, CME, what do you make of this? I mean, how do you judge the current state of actually working out where liquidity lies in crypto markets at the moment? Is there a sufficient mechanism for this to happen?
Sure, and thanks again for everyone for joining our panel today. My name is Tim McCourt from the CME Group. And I think the challenges with a lot of products and derivatives is when looking to define liquidity, I think the challenge is it means different things to different people. I think when we're looking at crypto, the challenge that we also have is there's an additional differentiation of like regulated and unregulated exchanges. So at CME Group, we're a heavily regulated organization. All our volumes are reported, our open interest reports, so kind of all our numbers are real, right? I think in terms of one key point of differentiation. But when we look at liquidity, it's really about like kind of what we were just saying is like how much can you put to work at a given time without having impact on price. And at CME, in terms of the futures, typically been monitoring what is the bid-ask spread on 5 futures contracts, which at CME our futures contract is worth 5 Bitcoin. So to trade 25 Bitcoin equivalent, it would cost you on average between 1 and 2 ticks to cross the spread. About 9 basis points is kind of what's occurring now. But the more interesting thing is that that's constantly replenished. So a lot of people will look at things like top of book or volume. These are really all proxies for liquidity. It's really more the trend that matters. So the fact that when you look at volumes growing and bid-ask spreads remaining relatively tight at CME, it's the conjunction of those things that we look at where we feel that we've built a pretty robust liquidity pool for the listed and regulated futures at CME.
Okay, thanks. William, what do you make of this at the moment in terms of actually technological aids in which cryptocurrency markets can either increase transparency or visibility of liquidity? What's the state of play at the moment from a very broad 30,000 feet point of view?
Great, yeah, thank you. My name is William, I'm from Curv. I'm slightly different than the rest in that we're more on the technology side, but we're still having a huge impact, or at least we hope we're going to have a huge impact on liquidity moving forward. And specifically what we're seeing is that Curv, and there's others as well, have technologies called multi-party computational wallet technologies, which are eliminating private keys completely from blockchain transactions. And by eliminating private keys, you really break this conundrum that's existed in the market for so long between security and liquidity. For such a long time, people were so worried about these keys being stolen, they built outrageous infrastructure around protecting these keys, and they also built tremendous infrastructure around keeping only a very small portion of their assets online at a given time. Once you have a private keyless system, you have assets that can basically be online constantly. Then there is no fear of them being lost or stolen or damaged. And so in that regard, liquidity, it can only go up. The cost of custody can only go down. And so we're just really excited to be part of that and watching our clients keep more and more of their assets available, make settlement easier, and should make the industry look a lot more like that standard industry that we all keep trying to become.
Okay, thanks very much. And just staying on this topic, I'm Jakob Palmstierna from GSR, excuse me. From the point of view of looking at cryptocurrency markets, how they behave and how liquidity especially behaves, I wondered if you could share any thoughts on the impact of wider macro events on how crypto market liquidity actually changes or perhaps doesn't change depending on the same events that would move traditional markets, perhaps.
Yeah, I mean, we're a market maker in the crypto space, and I guess we focus sort of more on the microstructure than we do focus on the macrostructure. But I think that what we can see is that, anecdotally at least, that global macro events and sort of unrest in the world sparks volatility in crypto markets, which we obviously like. And it's interesting that everybody speaks about crypto markets as being very, very volatile. What's more interesting for us is that they have to have a very high proportion of volatility of the volatility. So it goes from being very low volatility, which we have gone through a period now and just starting to come out of, through having very high volatility back in the mid-summers. So those are the two things. And touching on sort of most of the things that we've seen on the liquidity side, how does that sort of affect us? I mean, I very much agree with the fact that top of book and volume is sort of proxies for liquidity and doesn't represent actual liquidity. And the way that that's broadcast sort of in the real world for us is that we like to buy on the bid and sell on the offer and make the spread. But every single market maker out there will lean on a price. So if we get lifted on our offer, for example, and the market starts moving against us, the price goes up, we need to be able to take that liquidity from the market so we don't just run a loss. And that means that we lean on liquidity for other exchanges. And you can imagine when there's a lot of people doing that, there's a huge domino effect, which looks like there's liquidity across many different venues, but really it's multiple providers of liquidity leaning on similar price. So that can be something that you sometimes can see when you just you touch a price and it just poof disappears on all the different exchanges.
Yeah, I think one thing I would add to that, Dory, I think even kind of listening to the prior panel, is there is this theory of convergence, right, in other asset classes or other traditional markets, and I think you're starting to see more and more of that in cryptocurrency, specifically in Bitcoin from CME's perspective. My background before I joined the CME, I was an equity index trader, so my bias is very much towards indexing and trying to build products that converge between OTC, cash, derivatives, and kind of the OTC market for all these things to come together, because that's where market makers and liquidity providers and market participants can freely move between the available liquidity pools. That's why when we worked with crypto facilities for the Bitcoin reference rate, it was very important for us to tie ourselves in our futures contract to the spot market, because that's where people could offlay risk, source additional risk, and these things do converge at expiration. And that's why we have very strict criteria. And right now it's Bitstamp, ItBit, Coinbase, Kraken, and Gemini that are the constituent exchanges, because that's where, kind of going back to the original point, was that's where real liquidity is observed in the cash market. That's where they meet all the criteria. We have information sharing agreements so as a futures exchange, we can work with the spot constituent exchanges to make sure there's convergence and these things can actually happen, because otherwise the liquidity will be fragmented with no way for people to move between the liquidity pools.
Sure. Kevin, do you have anything else to add to that? I was really interested in the point earlier about how much large trades can move the cryptocurrency market and move the price of Bitcoin, by far the most one of the most liquid coins. Is that starting to change? This has been a perennial problem in cryptocurrency markets, the fact that a trade's done at very early o'clock in the morning in Asia, everyone wakes up here in Europe and starts to worry about it. Is that starting to change at all?
Yeah, so actually if you look at, there's a big difference between spot and futures in terms of liquidity, and I think probably driven a lot by the leverage that you get on futures. So for the same amount of money, you can do a lot more volume. Right. But if you look at the spot markets, every once in a while you see these wicks. They call them wicks, where the price moves dramatically, probably driven by a single person trading. And it's actually rarely, from what we've seen, it's very often just an individual out there who has a bunch of Bitcoin, like 600 Bitcoin, and he just wants to sell it that day, or she wants to sell it in that minute. And she just goes and hits market order sell. And that will move the price a couple % on that exchange, and then the markets will respond around it. But so I guess if you want to when we talk about liquidity, it really comes down to like, if I want to sell a lot of Bitcoin or buy a lot of Bitcoin very, very quickly. If you want to do it on a single spot exchange, you are definitely going to move more than probably $3 to $5 million. You're almost certainly going to move the market on that exchange. But if you go to a market maker that does electronic OTC or that can price trades and distribute that volume across many exchanges, you can pretty easily move $5, $10, $15 million in a single go, and you'll get a single fixed price for that trade. So it depends which type of infrastructure you're comparing it to. And if you want to go buy $5 million worth of Bitcoin exposure on BitMEX, you could do that in a single go without even moving the market at all.
Jakob, maybe you could talk to that point as a market maker, some of the methods which have emerged to help the market digest very large trades compared to a few years ago, perhaps.
Yes. Liquidity generally is not a new problem that we're only trying to solve in the crypto markets. Smart execution is a multi-billion-dollar business in traditional markets as well, and being able to move size without being picked up as a sloppy trader is very important for all algo and institutions out there. So I guess what we're trying to deploy is similar ways of, if we're getting indication of wanting to sell very huge, very large orders, we would usually trade those algorithmically over the day, where we would look for different pots of liquidity during different times of the day, and on average, we think that price that you would achieve would be better, and people wouldn't necessarily see what you're doing. But in the greater scheme, what I think all this is important for is that sometimes you can have great liquidity within the crypto market, and sometimes it just disappears. You can't touch it and it moves. And this really hinders the development for using crypto in the real world. So in the primary markets, where usually you're using crypto today, maybe the best use case that we have today is that it's already starting to be using cross-border payments. Cross-border payments is something where people won't go in and try and time the market. It's people want to send US dollars to Mexico at any given point in time. When you start using crypto there, you really realize how important it is to have a more contingent, high level of liquidity. And once you're starting to do huge block orders, you can think more about what we're talking about.
I think that's a crucial point, and one perhaps that we should have touched upon at the start of this panel. Actually, what is the chief implication or the chief impact of this patchy liquidity in the development of cryptocurrency markets? We've touched on some possible solutions to it, but given the very nascent state of cryptocurrency markets, William, perhaps you might be able to speak to this. I wonder, what kind of hurdle does this throw up, either for the development of cryptocurrency markets from the point of view of larger investors coming to the space, or even from the point of view of actually people starting to use this on the street in the real world? Is it an issue? It might not be.
Well, I will just tag on with what was just said. I will say that a very large percentage of the transaction flow through the wallets that we see with our clients is in the cross-border payments space. There's no question that that is where speed and instant settlement has the greatest need. I don't think a lot of people that are day trading their Bitcoin are coming in and out and withdrawing and doing a lot of on-chain transactions on a given day. Just the way the Bitcoin network works, that's not really what people are trying to do. But with these other networks, people are trying to do things instantaneously. They are trying to literally move funds immediately. And that is where, from a technology perspective at least, that hurdle is now gone. Right? So a lot of what people were talking about, these hurdles that are mentioned, these challenges about why there's such these diversity in prices, this all comes back to the fact that when we all started this, the technology wasn't there. It simply wasn't there to make sure that everyone knew what the price was in different places and they could move these funds easily. So now with multi-party computational processing, the elimination of private keys, these are now instantaneous transactions. These are now happening each and every second, hundreds of millions of dollars flowing around the world, either in XRP or through stable coins, or all these other use cases. So it's no longer just a small sideshow, I think, in the world of finance, to be honest.
Okay. Any thoughts from this side, just on the potential impact of patchy liquidity and this rather large headache for cryptocurrency markets at the moment, on the wider development of this emerging asset and its actual potential for starting to be used as something which is very useful, moving from potential usage to actually real usage in the real world?
So I think what's kind of cool about the market over the past 2 or 3 years is it's actually forming its own market structure. So you have basically the king in crypto is retail or individual traders. So the nice way of saying it is people with like longer time horizons than the HFTs or the market makers. The not nice way of saying it is like idiots gambling. It's people who are in it for a longer price rise over a longer period of time. And actually what's really interesting is to see the development of who controls that relationship, because that's ultimately the most profitable piece in the value chain. So up until a few years ago, it was exchanges that controlled that relationship. It was your Binance's, your Kraken's, your Coinbase, and that's why they can still charge, if you have fiat rails, a big premium. That's why Coinbase charged 1% for their instant buy app, because it's targeting individual buyers and sellers. So what's emerged in the meantime is companies like GSR and other market makers that have been able to knit together liquidity across a great many of those exchanges that allow people to access sort of a deeper pool, so to speak. What I think is really cool is like the CME, I would say LMAX is in the same group. These are institutions that don't traditionally face individual traders, but provide a place for market makers and other participants to lay off risk. And I would, as a regulated venue, I think it's safe to say the counterparty risk on CME is the lowest in the industry. So you're now starting to get these different tiers of where you sit in the value chain of you guys don't touch individual traders, but the market makers touch the retail exchanges and the individual exchanges, which is what we are. And it's going to be interesting to see where those relationships go. The other moving piece in the space right now is your Robinhoods, your Revoluts, your firms that are brokerages effectively. So they don't allow you to withdraw your crypto, but they give you access to the price of crypto. And those firms will, generally speaking, hedge one-to-one in physical. So if you buy $1,000 worth of Bitcoin, generally speaking, Robinhood and Revolut will be going out and buying $1,000 worth of Bitcoin. And that's in comparison to the CFD companies, which don't always do that. So those guys will generally try to face an OTC desk, someone that can price them Bitcoin in real time so that they know the price they're showing the client is the exact price that the client will receive, as opposed to having to guess it on an exchange. So the industry is changing very, very quickly. The thing that will determine who makes the most money in the long run is who can control that relationship with the individual trader, or who can be the dominant player in their segment of the market, for example, sort of institutional trading.
Yeah, I think that's interesting, because I think the one thing to note, right, CME is it's both helpful and can be a hindrance to someone who's trying to access the market, because CME has more of a hub and spoke network. We rely on FCMs, or financial commission merchants, and clearing members, where users can't necessarily directly access CME. You have to go through one of these clearing members or one of these executing brokers. But the upside is that makes it very easy, if you're a part of that network already, to trade Bitcoin futures at CME. Our contract is financially settled by design because it functions the same way in everyone's risk system, trading system, our clearing system, as a S&P 500 futures contract or a Russell 2000 futures contract. It's just the moving of US dollars between the arithmetic computation of the BRR, or the Bitcoin reference rate. So if you don't have those relationships, and that's still what is a gating factor for our network effect, is that FCMs are still not necessarily allowing everybody access to the product. They're not necessarily giving everyone the exchange minimum margin. So there's still some things that we can't control. But in terms of the user bases we're seeing, we do have a small retail participation, maybe let's call it a little bit less than 10%. But we define retail as like the active individual sophisticated trader. So we include like the professional class of individual traders. It's not necessarily this is not a mom and pop retail product. At CME. But we've seen the institutional really start to grow. We now have 55 large open interest holders in January, which is a record. Those are those people who hold more than 25 futures contracts, more than 125 Bitcoin equivalent. And we've seen open interest continue to grow. And I think what was interesting is over time, marrying the institutional class with some retail, with some nationals like miners, as well as some people who may just be long the digital asset. You have a mix of speculators, hedgers, and people who just want to access the market. That's what breeds the velocity in the market. And I think that's what we saw in January. Even though the price moves were not as extreme or violent in years past, we saw a more outsized volume reaction in the CME Bitcoin futures than necessarily what you saw in some of the spot markets as well, because the players are trading more, the velocity is picking up, and as more and more people come in, that network effect will only continue to grow.
I'd like to move on to regulation. This is one of the most crucial aspects of the whole cryptocurrency universe, and obviously for futures and other, say, derivatives, which have been drivers of liquidity, this is quite a key aspect. The same, of course, goes for spot. But Jakob, I'd like to ask you just your thoughts on where we are at the moment in terms of regulation and how this is actually impacting liquidity and where liquidity lies. In theory, we'd have a situation in which liquidity would coalesce around regulated venues. In reality, I'm not sure if that's playing out exactly as one would expect. How do you see this at the start of 2020?
I think there's two camps. I think there's one camp who's definitely not interested in having, a sort of a regulatory umbrella to operate under. It's not the way that they make money, or they are not incentivized to participate in that part of the market at all. But more and more, and GSR stands on the other side, we have a pretty big following of people who wants to create a regulated market to, make it a consumer protective market. What is notable now is that we have an unregulated primary market, an unregulated secondary market, and a regulated, I think it's called like tertiary market, the third market, which is the derivatives market. And if you think about what we're trying to create, if it is a functional primary market, places where people like Apple, maybe Apple is a bad example, they don't need any money, but S&P 500 or corporates can go out and have easy access to cash, to credit in a different variety of forms. The secondary market and the derivatives market sort of provides that liquidity. And if we continue to focus on, cross-border payment, companies trying to use crypto for within their processes, I think it's so obvious that we need a regulated secondary market. Hopefully with that regulations would also come, less fragmentation of liquidity. Liquidity will, start focusing in on a few exchanges where also those not gambling, 100 leverage type participants will go, but those who want to participate in this market will add liquidity there. That's why I think it's important with regulation.
Okay, fair enough.
I have a bit of a contrarian answer to this question whenever we have this question.
Excellent.
And I think it's time we mix things up. This is too boring. No, I actually think that the regulatory environment is pretty clear. I think a lot of people come on these panels and say, oh, we need this, we need that. I'm not sure. I mean, in the United States, for example, the CFTC makes extremely clear what they have control over and what they don't. They tell exactly everybody what they should be doing, what they shouldn't be doing. They've made it very clear what securitization is in the United States. They've made it very clear how to file a security token under Reg A and Reg S and Reg A Plus with the Jobs Act. The same thing is true throughout Europe. BaFin just came out with this fantastic regulatory environment for Germany, which is going to be more widely adopted throughout the EU as well. Most of our clients are regulated entities. I'm not entirely sure what people are still waiting for. I really am not.
Has this had a positive impact on liquidity, would you say? That clarity certainly, as you've
I think that
outlined,
the
exists.
institutional, there's no question that, that institutional players are getting far more heavily involved, even if they don't want to talk about it out loud. They're getting far more heavily involved on the back end than people think. Every major bank that you hear about has a desk, whether you know it or not, in which they're experimenting with or thinking about or already actively trading the currency. And I think they're doing so because they appreciate now that they understand what the tax regulations are going to be for them, what the tax consequences are, and what the regulatory environment is. So I think we're closer, a lot closer than people think, to be honest.
Okay, fair enough. Both representatives of regulated venues, does that make sense to you? Do you see regulation of trading venues as currently adding to liquidity, being a net positive for liquidity, or do you think that there's some gaps there? Maybe, Tim, you might be able to speak to this.
I think it's a net positive, right? And I think sometimes the focus is people have a negative viewpoint on regulatory, because they're thinking about it from a kind of quote-unquote like interference perspective. And what does this mean for me, and the introspection that may come along with it? But I actually think it's quite the opposite. When you look at the institutions and organizations like CME, which is nearly 180 years old, there's a long-standing tradition of transparency. It's tried, it's tested. We are the regulated venue for cryptocurrency and all of the other asset classes when people need to manage their risk. The regulation provides clear-cut rules of the road, not only for how you're operating current markets, but how are you going to introduce new products, how are you going to change your rules. These are all things that are done in the public domain, publicly available, and highly transparent. That's not necessarily the same thing you get from unregulated venues, where, yeah, there may be the akin of rule books and things like that, but it's not clear how and when they can change them or what they can do in terms of trying to maintain markets and things like that. But regulated venues gives people the confidence that they know what they're getting into and how it will act and perform for the foreseeable future. And that's of critical importance when you look at, I think, institutional flows and putting real size to work in the market. So I think it's a net positive, but I still think everyone has a different timetable for when they reach either that point of regulatory certainty or when they still feel comfortable entering the market. But without that regulatory paradigm, I think they would still be sitting on the sidelines.
Kevin, does that make sense to you? I'm just wondering, given that trading venues and platforms where we do see a lot of liquidity are either located in the kind of place that you'd probably like to go on holiday to because very nice beaches and so on. Yeah. You know, is regulation as it exists at the moment maybe either from the US or other major financial centers, the EU and so on, does that have the power and the actual scope to be able to tackle large pools of liquidity at very opaque and untransparent venues, which do suddenly cause a headache for crypto markets and how they function in some ways?
Yeah, so I've been in the space professionally since like 2014, and for the entire time I've been in this space, the defining issue of the space is regulation and how you respond to or avoid that regulation. So regulation in general favors incumbent firms. So you need to have, no offense, 150 years of operating history to be able to show up at the CFTC office and with the right lawyers and say the right things at the right time and know exactly what the reporting looks like. It's a very, very heavy infrastructure to maintain regulation. So we are FCA regulated, but we still do face individual clients and we do give 50x leverage. And managing both is a very, very heavy lift to do it properly. The road is just littered with bodies of firms that tried to do it properly at the wrong time. They tried to look like the big guys and couldn't. So no offense if they're in the room, RSX, CeedCX are having a little bit of trouble right now going down the fully regulated path because they don't have that infrastructure, those FCMs that they can connect to with one page contract that they're already talking to. So the people that don't play by the regulated rules have a great advantage when it comes to launching new products. So FTX these days is launching product faster and better than anybody I've ever seen in this space. Binance puts stuff out at a furious pace, and it's incredible to watch them work. But if you try to make the unregulated guys play by the regulated rules, it falls apart pretty quickly. So if you look at Binance US, Catherine Coley's doing a fantastic job trying to roll that product out. That is a very tough sell. I think their volumes are like single-digit millions last time I checked. It's very hard to put an unregulated product on top of a regulated infrastructure and expect it to work remotely properly. So it will be interesting to see how it develops. You guys obviously have structural advantage with sort of existing infrastructure. The guys like the Binances and the FTX have structural advantage by they've already made their bed with the fact that they're not going to be regulated, and that's it. And then you have people in the middle like your Coinbases, your Krakens, your Bitstamps, your Kraken futures that make best effort to do things properly, but still try to service the individuals. So it's a very difficult road to navigate. Not to mention, the regulation is different in every country. So right. Japanese regulation is different from Korean regulation, is different from American regulation, is different from European regulation. And if you want to compete at the highest level in every country, you really need people on the ground to be able to respond efficiently.
What kind of impact does that have on these efforts to overcome the intense fragmentation of liquidity that we see at the moment in cryptocurrency markets? If you have a situation, as you've just described, where unregulated venues essentially are putting two fingers up to the sheriffs in town, they're saying, we don't care, we're not regulated, we're still getting customers. Does this bode ill for the crypto universe in the future and for this narrative of bringing cryptocurrency into something which is safer and more regulated and away from unregulated exchanges?
So I think it's an important point that there's a strong difference between exchanges that are appropriate for a retail audience and exchanges that are appropriate for an institutional audience, right? This is an institutional crowd, by and large. Large American institutions are not going to trade on unregulated areas because why would they if they can trade with CME? I mean, there's just no, and we make sure they're safe and make sure that they're passing their KYC and they're not doing business with bad actors and all the rest. So I think the reality is that the large institutions that are getting involved are clearly going to do so only in a regulated fashion. I think clearly there's enough liquidity there to handle them. And the retail, like you said, Binance is an amazing thing. They're doing huge things, but that is largely a retail audience. There are definitely some large asset managers, I guess, who are probably trading there, but it's going to be interesting to see what happens if you start seeing larger institutions getting involved. I just can't see them trading on an organization that runs the reputational risk as some of these exchanges do.
Fair enough.
Sorry, if I could just add one real quick point. I actually think the unregulated exchanges have been the driver of growth of the industry so far. So everybody talks about technological, tokenization and all this stuff, and it's great and it's really fun. But actually, there's been some major innovations in the financial infrastructure of the space. So 3 off the top of my head, the direct access exchange. So Mt. Gox, Mark Karpellis, for better or worse, invented more or less the concept of an exchange where everybody on earth could connect to the exchange, place trades. It does all the clearing, the settlement, the custody, all done in one single venue. Now Coinbase and Kraken copied it and turned it into like a real viable professional business, but that was an unregulated innovation. Say the inverse futures contract, which is the vast majority of what is traded today on BitMEX, Deribit, Kraken futures. We all trade what's called an inverse contract. So normal futures, you show up with dollars because you want to bet the price of soybeans. Inverse futures, you only have soybeans. You basically show up with a truckload of soybeans and say, I want to bet the future price of soybeans. And you need a different contract to do that properly. That was invented by a Russian guy called Alexei and ICBit, which is a completely unregulated derivatives exchange. The funding rate. So to the best of my knowledge, Arthur invented the funding rate. So that's the idea that how do you create this 50x leverage on a spot price? You need a mechanism that forces the price to go back towards the spot underlying index. And Arthur at BitMEX invented that concept, which is what allows 80+% of the volume you see in crypto traded today to operate. The insurance fund at BitMEX. See, there's some major innovations that have come out that underpin the vast majority of trading activity in the space were pioneered by unregulated venues, and I think it's very healthy that they're out there experimenting, and I think it's also very healthy that people like Kraken Futures and the CME aren't adopting all of these things until we see that they work properly and can lead to a fair and orderly market.
Yeah, I think that is the upside. They certainly are able to be more nimble, right, than regulated venues. You look at CME, right, we launched Bitcoin Futures in December of 2017. We just launched Bitcoin Options a little over 2 years later. It's not like we weren't trying to move that forward internally or even with our regulators during that 2-year span, but we also are held to much higher standards, both by regulators, but more importantly, our customers and the market participants. So we have to be a little bit more prudent, but I think that is one thing that we are seeing, the innovation or the speed of innovation from some of the platforms that were just being mentioned. is certainly welcome. It's a lot of fun. It's very interesting to watch. Curious to see if any of them will kind of cross over into the regulated space. But that's also the degree of freedom that they enjoy that we certainly do not.
Fair enough. And another driver of innovation you've mentioned is obviously the role of technology in this space. I'm just trying to understand at the moment exactly what have been some of the key kind of tech breakthroughs or key drivers of this effort to boost either visibility of liquidity or transparency in liquidity. But to open this up, if anyone wants to jump straight in here.
We haven't heard from you for a while.
No, I mean, robustness of these exchanges has been a huge issue. I mean, I think many of those innovations that we talked about earlier, haven't been driven by, sort of the human good or solving a universal problem. It's usually been driven a lot by greed, and there's a lot of greed baked into how those innovations has been created. So we don't have a level playing field. A lot of these exchanges have been allowed to be built up with subpar technology, which causes a lot of headache for somebody like us trading with them. Smart order execution is finally available through people like Curv, where we don't have to go around and put in private keys and access individual accounts. We can seamlessly move money around from different liquidity pools. That should certainly help to sort of the direct volume and capital to where they are most secure and best pricing. So I think certainly on that pace we are moving towards the right frameworks.
Okay, William,
Yeah,
does that make sense to you?
I like to liken it to a little bit of the story of the internet, in that the internet started with dial-up and it went to DSL. I'm probably the only one old enough to remember DSL, and then I'm certainly the only one old enough to remember dial-up. And then it went, of course, to high speed and high broad. So we started with single sig transactions. Bitcoin was in the low 100s, 200s, and then multi-sig was invented, which is a huge step forward in safety. That got people more excited. That made the industry a lot more practical. That got us from 200 or 300 up to the thousands that we are now. Now MPC technology is removing keys completely, right? So now we're going from DSL to high speed. It's going to be very interesting to see, once you can take away the fear of loss and damage and theft, what that really does to the industry, how that lowers the underlying costs on the back end, and then therefore how that makes the front end, these guys who are building these amazing products, how that makes their products more efficient and a lot more affordable for the end consumers.
Fair enough. I'm aware we only have a few minutes left. Tim, can you encapsulate, from the CME Group's point of view, exactly how you see tech as driving changes in this sphere? Maybe if there are any particular examples from CME itself.
I wouldn't necessarily that I think there are any necessarily specific examples that are crypto specific at CME, but that's part of the offering, right? Is that we have effectively one match engine, all of the products are on the same match engine. We're constantly looking at ways to innovate on that in terms of the delivery of data, the management of latency. How do you kind of get that inbound and outbound order flow kind of quickly, as seamlessly as possible to the market? So I'd say just kind of the innovation in general is really more around the access to the markets and continuing to focus on the trust, the security of both the trading and clearing networks, but nothing necessarily that is crypto specific, mainly because our product is financially settled, and that was part of our primary focus. And if we do kind of move into other parts of the ecosystem, that might change, but right now it's largely just a function of the Globex distribution, which is worldwide, trades nearly 24 hours a day. Except not on the weekends, as people like to point out for Bitcoin futures. But yeah.
24/5.
We also shouldn't downplay the innovation that they just came up with as well. I mean, the innovations in the future space is that both of these folks are working on is taking us to the next level. They're probably being more modest than they should be, but.
Kevin, last couple of minutes of blowing your own trumpet.
No, actually, can I pose a question and then answer it? That
you can do that. You can do that. Yeah.
Everybody's like, oh, the volumes on these exchanges are fake, and we just accept that it's fake, but no one ever asks why they're faking the volume. So there's two main reasons, and I don't have any there's no quantifiable study on this, but I've heard it from a market maker who might even be in this room. I don't want to reference his name unless without his permission, but There's two reasons why. One is if you are a new to crypto person and you go on CoinMarketCap and you want to figure out where to trade, you might go to the place with the highest volume. But that's a relatively small set of people, and it's a relatively short-term game. The real audience for the fake volume is actually token listing projects. So if you have an ICO or an IEO, like one of these, the crass term is shitcoins, but like one of these like smaller tokens where you've raised tens of millions of dollars from a number of people promising a future development, the hardest part you have is you have to convince, one, your base and the market that there's liquidity and there's access to this product. So they will pay listing fees to these exchanges, and those listing fees often correlate to the fake volume, somewhere between $50,000 and $500,000. So the fake volume isn't actually there to fool people like GSR. They can see through it in a second. The volume is there to fool the token listing projects into paying a listing fee so that the exchange can get more just cash into the bank. Sorry, just, yeah.
Okay, fair enough. It's a great
Also,
point.
Kraken Futures
Yeah.
is great.
There you go. There you go. On that note, I'm afraid that we've run out of time. So I'd like to say a big thank you to all our panelists, and please enjoy the rest of the conference.
Thanks.